Hello from Trend Signal for our review of the data and events the week beginning the 8th of February. We're actually putting this together on the 9th of February. It is a fairly quiet week in terms of data, but there is a lot going on in the markets, which I will attempt to explain. Last week, markets took quite a bit of a tumble. It wasn't the non-farm payroll data, the employment data out of the States that caught the headlines, really. But it was more the manufacturing, but more importantly, the poor services PMI data out of the US that pushed the markets really to decide that the Fed is going to be very unlikely to raise rates in March. In fact, looking at some of the Fed funds futures, it suggests that the US is unlikely to raise rates this year, let alone March. So really it was the straw that broke the camel's back as well. In a way, the US dollar gave way in a significant way, falling sharply versus all the majors. As I said, those Fed fund futures implied little to no chance of a rate cut, certainly not in H1 and unlikely this year. Mixed news on Friday for the non-farm payroll report, which only slowed the market's falls in a way, although whilst total new jobs was less than expected, the headline rate did actually fall from 5% to 4.9%, and interesting to see a jump in the average earnings, beating all expectations, really. News over the weekend had little effect on the markets. The North Korean rocket launch caused a few ripples, but nothing much. China, it's the Lunar New Year on Monday, yesterday that is, and the Chinese markets are on holiday all week, as you'll see from this calendar here from Forex Factory. So the Chinese market's shut. It'll be interesting to see how they react to all the goings on next Monday. However, a lot to talk about, as I say. Stocks got whacked last week. The FTSE was off about 3.5%. The Dow down 1.5%. S&P down 3% as some of the big components got hit quite hard, certainly LinkedIn disappointing the markets. The Nikkei falling precipitously and has been falling again this week sharply as well, but last week fell 700 points, that's 4%. And just to underline the fall in the US dollar, Euro dollar, that rallied 323 points, that's 3%. Even sterling, which has been a bit of the bête noire of the markets, that was up 256 points, just shy of 2%. And the story of the week, like the Nikkei, was dollar yen, down 468 points as the yen continued to rally, attracting safe haven flows. That's a fall in the US dollar rate of just under 4%, so quite significant. Not surprisingly, the likes of gold rallied sharply, a dollar-based commodity, and tends to do well when the markets are doing poorly. Oil didn't have such a great week, really, but it had a stupendous week the previous week and managed to shed a little bit, about $1.50, $1.75 on Brent crude, which actually is still down 5%, but it does fly around. And some of the base metals, the likes of copper, starting to pick up a little bit, up 31 ticks last week, or 1.5%. So what a difference a month makes in the financial markets. Only 6 weeks ago, the Fed raised rates, and the markets were expecting 2 or 3 further hikes this year, or as some financial newspapers were implying, it should be 4 hikes this year. Well, that was then, and now it is very much not on the cards. The move towards negative rates is very worrying. Moves like this and the continuing rally in bonds suggest that the threat of recession in the world's major economies looms large. Yesterday we saw a significant move as equities came in unchanged at the beginning of the day, but got just relentlessly sold off throughout the day, and then the US came in and then sold off even further. We did get a late rally in the US, more of a sort of short squeeze more than anything else, but it is a very worrying development. Banks got smashed last week, and they got smashed again yesterday. UK banks really under the cosh. Of course, they are very exposed to any downturn, which reduces their ability to earn, really, putting pressure on margins in borrowing and lending, and I guess not to mention the increased likelihood of defaults and bad debts, etc. And the effects on the FX markets were also felt. US dollar fell, and all the US dollar-based commodities took their lead, as I said, apart from crude oil, which had a big jump from the previous week. But so what happens now for global markets? Well, China is slowing down. Japan has resorted to extraordinary measures to try and jumpstart its economy. But in fact, overnight, I've just got a report, but I just bring it in here. Overnight, the Japanese stocks fell sharply, following on from the very precipitous fall in the US dollar rate. That's the yen attracting a lot of safe haven flows, which really has caused the Nikkei to fall sharply overnight. But also very worrying is the yield on the 10-year government bond. For the first time ever, the yield of a G7 sovereign bond, a 10-year bond, has gone negative. In fact, this report from MarketWatch reporting that the yield got down to a minus 0.025%, as the report says, meaning investors were willing to lend the Japanese government money for 10 years and get back less money than they put in. All these moves on yields, negative yields, etc., have dire consequences for the markets and the way companies and retail and consumers, how their behavior is. If you think about it, it's possible that institutions will not want to hold cash. They will not want to be paid up front for things. They'll want monies to be paid late, for example. There's a lot of consequences of this. Obviously, there is still the counterparty risk, but I think it's a world that is going to be very different and difficult for people to understand, as the cost of holding cash becomes quite a burden for the markets. But these yields continue to fall, and now negative yields seem to become the norm, really. And I'm sure central bankers will be putting their heads together to try and work out how they get out of this problem that they've created themselves. Sure, it's a great way of oiling the financial machinery, getting liquidity into the markets, but it's had a significant downside as well. Let's have a look at the data and events. After all, that's what we're here to talk about. Very little coming out this week. It is what normally happens after non-farm payroll week, which is always the first week of the new month. This week, really, all we've got to focus on is central bank. As we've talked about central bank largesse, we're in the grip of central banks and central bankers. They're deciding our fate from one day to the next. We continue to watch out for any speeches and comments from central banks. And this week it's the turn of Janet Yellen, the chairperson of the Federal Reserve, the U.S.'s central bank, who is testifying this week. There are two speeches or policy testifying to the semi-annual monetary policy report, let's get it straight, before the House Financial Services Committee. I meant to say there are two speeches she's given, one on Wednesday and one on Thursday. They released the text of the speech, but it's interesting just to hear her responses to various questions put to her by the Financial Services Committee in Washington, D.C. Obviously, being a central banker, what she says often reflects their policy, so that could move markets. Watch out. Manufacturing production in the UK on Wednesday. We had surprisingly good manufacturing and services data last week from the UK, which is odd, bearing in mind Mark Carney, the Governor of the Bank of England, recently downgraded forecasts for the UK economy, which some people have sort of questioned, really, bearing in mind the fall in sterling should help exporters, and with obviously no threat of inflation, it seems an ideal scenario, but time will tell, as they say. We have to jump to Friday for the next really important bit of information, really, which is the Eurozone Q4 GDP reading. This is the first reading to be reported. In fact, it refers to the prelim German GDP, but in fact we have the Eurozone GDP out, and our expectations are for a rate the same as the previous quarter, so that's plus 0.3%. And finally, our University of Michigan Consumer Sentiment number, which is always a very good leading indicator. Surprisingly, we're forecasting an uptick to 92.6. But suspicions that these markets might have affected that or will be affecting that reading. And also we have retail sales out at 130. A not too exciting number. We're expecting an unchanged reading from the previous month. And that's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.